All right. Well, thank you everyone for joining us for this week's Exit Advisors Town Hall series. We've been hosting these for, I think, about 18 weeks now, and they just keep getting better and better. We've featured some really great topics. We've had great turnout, and they're getting more and more interesting. So before we kick off, though, I want to give a quick little overview and introduction about Exit Advisors. For those of you who do know us, but for those of you who do not, we are a Houston-based M&A advisory and transaction consulting firm that focuses primarily on the lower middle market. And we work with entrepreneurs and seasoned business owners alike, months or even years in advance in order to custom build a strategy that will help them increase their valuation and help them exit or sell their business. We also take a collaborative approach by partnering with other CPAs, private equity groups, financial planners, and search funds to help them bring more comprehensive services to these transactions and to their clients. But this week, we've got a really, really special series featuring our very own Al Danto. He is the managing partner of Exit Advisors. He is a serial entrepreneur and a professor at the Jones Graduate School of Business at Rice University. Al's got, over 30 years of experience working with startups and entrepreneurial companies and has expertise in every facet of, from starting, growing, or selling a business. So Al's a really great guy. He's a close friend, and many of you probably know him or at least know of him. I had the pleasure of taking his classes while I was at Rice, and I can tell you these topics are absolutely invaluable for business owners and entrepreneurs. And a lot of what you're going to hear today and our future town halls come from his graduate level courses. So be sure to tune in. Without further ado, I'll pass it over to you, Al.
Thank you, Andrew. Really appreciate it. It's great to see everybody out here. Those that know me and taken my classes before, it is hard for me to sit here in a chair and teach a subject and not be up walking around and being all energetic. So you know me, I'm gonna give it my all and put it in here. It's gonna be a whirlwind today. As Andrew said, these are the lessons that I teach in my class. So my former students, I see several of you out there, you'll be familiar with it. I might cold call you, see what you remember. But there's a lot on the topic, but it's going to be a whirlwind. So we're going to go through it. What I really want to touch on today, I want to make sure that here's my key takeaways. I'm going to talk about the most important business lesson that I ever learned in my entire career. It changed my fortunes forever. And people ask me, give me one lesson. This is what it is. We'll talk about reasons for a formal business valuation. We need to understand by the end that every business must be evaluated on its own merit, and don't get fooled by averages. If there's one takeaway that you take away from this, I want it to be that. And if I ever see any of you down the road and I ask you one thing that you learned from this and you can't tell me that, I don't know what I'm going to do, but I'm not going to be very happy with it. So that's the one real key takeaway. We're going to walk through an overview of the valuation process. We're going to understand that risk from an investor standpoint is asymmetrical. They don't look at it the same way that the seller or the person who's trying to get the investment looks at. I'm going to touch a little bit on the potential impacts of the COVID disruption to valuation, and then we'll leave a little bit of room for questions and answers. So if you have any questions, put them in the chat. We've had several that'll come through. I'll address. I'll stay over about 15 extra minutes to answer any questions. I'm sure there's going to be a lot of questions, so I'll take some time at the end. Instead of stopping right at 1, I'll stay after and answer some questions. So without further ado, let's get started. For those of you that don't know me, here's a little bit about my background. I was 23 years old. The person in the upper left is Blaine Smith. He worked for an envelope company. He was one of my suppliers to NCR Corporation, where I worked, and I was in charge of coordinating envelopes to be at our systems when we went live and had to put business forms and everything into them. His company went out of business, so Blaine approached me with the idea to start a company to distribute envelopes. I backed him, and that was my apartment. The person on the bottom left is Jeff Edens. He was probably the top envelope salesperson in Houston. He sold to all the major companies, Cisco Foods, Schlumberger, the big oil companies, the big banks, and he brought all his accounts over. we gave them half the profits, and we ran the business out of my apartment. We grew it. We started to acquire some of our small manufacturing companies, and probably about 5 or 6 years into my business career, I was at a Houston Aeros hockey game with one of the founders of Houston, EO Russell Vale, and we were talking about his business sale. He had just sold his business, and I got a little starry-eyed at the number, and I never really thought about selling my company before or even what that process would be like. We're just too busy growing it. So he said, if there's one thing that you need to do is build a predictable recurring revenue stream, take out risk, and know when to get out. And I said, Russell, I own a printing company. How can I do that? And he said, I don't know, but you better find a way. Literally, it was like saying, you know what, I'm going to become a vegan for the rest of my life after being a meat eater. And I completely changed our marketing strategy and said, you know, how can we get recurring revenue in a printing company? And we started to go after newsletters and short-run magazines. We'd partner with software companies. So when they install a system, we would be referred for the forms and the products, and really revolutionized our business. What it resulted in was I sold the business. I think had a very fortuitous timing. It was in the late 90s. I decided I wanted to sell the company as the industry started to change, go more electronic, more tech orientated. And I said, I want to go back and get my MBA. People thought I was crazy. So what are you going to do next? I said, I don't know, but I think it's time to get out. We sold the company to a private equity group. And we walked away with an incredible valuation, well over the industry average. We're going to talk about industry averages. So just really that one strategy of trying to find a predictable, recurring revenue stream that was consistent, and we didn't just have to go out and bid jobs, changed the perspective of the company. It really changed my fortunes forever, and it enabled me to sell the company at a young age and go back to school, get my MBA. I was at Rice. I was in the new enterprise class that I teach now. I actually have my business plan right here. It's a copy of the one that we wrote. And one of my classmates was a PhD nurse, and she had this idea to recruit and place nurses in the U.S. from the Philippines. And as crazy as that sounds, I said, you know what, I'm gonna back you in that business. And we did it. We wrote the project. We wrote the business plan in the new enterprise class, and we launched the company. The company grew, and we actually formed a major joint venture. It's us in the Philippines. A school down there changed 100+ schools into nurse training, and we took the nurses and we placed them in the U.S. and eventually sold the company. And when I got through at Rice, people started to reach out to me to just for advice on whatever it might be, typically around acquiring a company, starting a company. Like Andrew said earlier, I've had a lot of experience in startups and acquisitions, and started to teach some classes at Rice, and that's evolved into pretty much I teach a full-time career, a full-time course load at Rice, and we have exit advisors. We do the sell-side advisory, and we do valuations. So that's a little bit about my history, and I want to dive into the subject today. So, what are some reasons for independent valuations? Valuations have to be done for tax reasons, estate, gift, charitable contributions, and other reasons when there could be a taxable event, divorce, equity compensation, insurance, buy-sell agreement, lawsuit, loss of revenue, employee stock option programs, and a lot of other reasons, for valuations. Today, for this conversation, we're going to focus on the valuation of established, privately held small businesses. Just a quick note on public companies, and maybe some of you are familiar with maybe valuation in that area or venture capital. Small privately held companies are a little bit different. We'll go into the reasons for that. In essence, with a public company to a private company, size really matters. Larger public companies are typically a lot lower risk. They're just probably not going to go out of business tomorrow, like a small business could. They have access to capital. There's an open market for their shares. There's diversification of the stock. So a lot of reasons why they get a lot of higher values. And when you hear some of these valuations, some people are shocked for the first time when they hear what a valuation of a typical small company is. It's also a little bit different than early stage or high growth VC valuations. This is really not a valuation to sell a business and take and get a return on the investment at that time. It's investment capital to grow the business. It's not a complete buyout, and typically it's going to be based on the future exit, not the current cash flow. So privately held companies are valued on their current cash flow and the risk of those cash flows. The types of valuations, you're going to hear asset value. An asset value is just simply taking all the tangible marketable assets, adding them up and subtracting the liabilities. Typically that will set the floor. It's important to remember that most tangible assets will typically not have market value. You can't sell a reputation. In most cases, certainly you might be able to sell a name, but a lot of tangible assets, you really can't sell them. So there's not a whole lot of tangible market value to it. So the asset value sets the floor. It sets the floor, kind of a worst case. Market value is based on market comparisons. When it comes to the small business valuation world, as we'll talk about in depth today, it's very hard to have a market comparison. Different features of each company, location, how they're marketed, types of customers, all these different things that we'll talk about later. So market value is very hard, may give you a slight indication, but it's very hard to make those comparables. So what we focus on is the income value. It's the return on the investment for the appropriate amount of risk. What's the expected rate of return? An income valuation is most often used for small privately held companies. Here's a bonus question I always ask in class is that, do you think a business with more tangible assets is more or less valuable on average? Usually surprises everyone to find out that it's typically less valuable. And the reason is it might be easier to finance, but the valuation based on the cash flow is typically lower because you have to replace those assets, they wear down. And like me, when I bought printing companies, we'd have to take a budget for capital improvement, capital expenditures. So it's kind of a bonus tidbit there for you. The IRS and its rulings determines fair market value at the price at which a property would change hands between a willing buyer and willing seller when the former is not under any compulsion to buy and the latter not under compulsion to sell. Both parties have reasonable knowledge of the facts. So this is really what would a business exchange hands at, right? Based on the return of capital for the risk that's being made. What's the fair market value at that without any motivations? Strategic buyers can have a motivation to buy a company, to take out a competitor, add market share, do an acqui-hire, hire talent. And they may be willing to pay a premium that's above fair market value. But what we're going to talk about today is going to be fair market value. And how do you determine the fair market value of a privately held company without a market? So what I'm going to do, I use this example. I'm going to take Linda's Flower Shop. Linda has 2 stores. Each store has about $2 million in revenue and $400,000 in cash flow. Each store has averaged the same revenue and income for 3 years. This is what we're going to do. We're going to start out with a question for everybody. What is your estimate of value for each store, for one store, based on national averages? So what I want you to do right now is send Casey Bright, find him in chat, and send him your estimate of value based on the national average of a company of small business having $400,000 in cash flow. So go ahead and send that to Casey. So what do you think that valuation should be? It's a flower shop with $2 million in revenue, $400,000 in cash flow. So the winner is going to get a $100 gift certificate from Robert White, who's a great friend of ours. He runs Japaneros, Guru, in Jupiter out here in Sugar Land. If you're not in the Sugar Land area, give you a choice of a gift certificate to Common Bond, which another friend and speaker of ours, George Joseph, runs. So we will give you a gift certificate there. So go ahead. I think is there a question there? So simply just put it into case of what do you think that the value of one of those flower shops would sell for? $400,000 in net income, $2 million in sales on average. This just recently came out. This is very interesting. We're going to start talking. I'll give you a second. I'm going to give everyone a second to put their answer in before we move on. Hey, Andrew, it looks like Jose might have a question.
Yeah, Jose, I responded to it, but for everyone, while you do your answers, the slides and the presentation, we'll email that out afterwards, and then you can also access all the prior town hall series and other really cool resources on our website. So check it out.
All right, there's 70 people on here and there's 25 answers, so we got some shy participants here. Go ahead and put your answer out there. Send it to Casey. All right, Casey, let's cut it off now. So we're going to start talking about averages. This came out from Pepperdine. I encourage everyone, we're going to send out a link to the Pepperdine study. It is probably the foremost, most respected study on small business valuations in the small business marketplace. So this is a chart of the median multiple paid for small business acquisition. They go back by quarters. SDE, if you're not familiar with the term SDE, it means seller's discretionary earnings. It is all the income that is available to the seller. Out of that, the seller has to pay themselves a salary, car expense, insurance, benefits, everything. So small businesses, you'll hear the term SDE, seller's discretionary earnings. This is all the income available to the seller. From the valuation side, what we do, and I'll talk about a little bit later, we take all those earnings and then we will typically back out of that a reasonable compensation salary to run the business. So what you'll see, the top half, these are companies with less than $500,000 in seller's discretionary earnings. They sell for an average of about 2 times whatever the seller's taking out. So if the seller's taking out $300,000 total, they're going to sell for about $600,000. As I talked about earlier, that it'll go up in value as companies get larger. So we see it real here early on. $500,000 to $1 million in SDE, what the seller's putting in his pocket, will typically sell for about 2.6, 2.7 times. $1 million to $2 million, it goes up to about 3.3. Here's a really interesting factor, an observation. This is 2020, which is going to start to reflect the COVID impact evaluations. We don't see it as much on the smaller end, maybe the owner-operator smaller end, but look at the difference that we're starting to see as we move up. Now, companies that are get up higher in earnings, they deal away with the SDE. Typically in the EBITDA, you've got a deduction, an expense for the president, the CEO, the owner to run it. So we express it more in EBITDA terms. If we were to do this on the lower end at seller discretionary earnings and we took out, let's say $100,000 salary for an owner, this number here would go up. The multiple would go up. Right, so if we took out $100,000 and it was $400,000, probably go up more in the 3 level, 3 to 3.5. As we get up higher in $5 million to $50 million, now again, this is earnings. We see valuations go up. Look at the impact from historic numbers, looking backwards to 2014 versus 2020. So we're seeing a higher impact on valuations at the higher end as businesses get bigger. probably makes more sense. We're dealing with private equity, capital, larger. So we're seeing a higher impact there. It's going to be interesting to see how that plays out the second and third quarter as we move forward. So what's the problem with averages? So you say, okay, I know what the average is. What's the problem with averages? Well, here's my key point. You should never, and you can never apply averages when you look at business valuation. If you're looking to value a privately held company on its own, you should never look at averages. Why? No two businesses are the same. Increased risk, uncertainty decreases value. And at the end of the day, companies that are less risky and better prepared, well, they warrant a higher valuation. They just simply warrant a higher valuation. So as you look at this bell curve, and anytime you hear the word averages, just remember it's just the center point of a whole group of data. And that data is going to have a wide range. And when it comes to small businesses, there's a wide range. Even though the average may be in the 3 to 4 times EBITDA range, we see businesses that'll sell for 5 and higher, and you see them that'll sell for 2 and lower. And at the far end of that bell curve, you may see a strategic buyer that will come in there and pay maybe some crazy number, right? So Facebook paid like $19 billion for WhatsApp. WhatsApp wasn't very profitable. People say, why would Facebook pay that much for it? Well, they were able to convert WhatsApp customers to Facebook and vice versa and use it. And the value to Facebook was a lot more than the fair market value, but certainly never would have gotten that fair market value. So strategic buyers may pay more, but they're paying more than fair market value. That's what it comes down to. Just like if you wanted to buy a house in a neighborhood and maybe you had your mother-in-law in there to watch the kids or something, you might pay more for it. So strategic value is not fair market value. So if you're a seller, you want to think about who a strategic buyer would be, who may pay more than fair market value for my company. That's what you want to look at. So when we work with sellers and we look at strategies, that's the first thing we look at, who could be a potential strategic buyer. So let's move forward and kind of continue this discussion on averages. Again, averages are just flawed. They're just a center point. So here's a little caricature. The average depth is 3 feet, but you're going to have 9 and 10 feet in there. This is a picture. Where would you think this might be? Somewhere up north, Minnesota, Michigan. I asked my students to guess this in the class. This is actually Dallas, Texas. So it was Dallas, Texas, February 2011. It was 15 degrees and 6 inches of snow. So if you came to Dallas dressed for the average day, you'd have froze your butt off that day, right? So just be very careful of averages. So how does it relate maybe to the small business valuation? So you can take a look at all these historic, say their 3-year historic revenue graph, all the same average. Okay, this is the first kind of lesson in valuation. Are they all going to have the same value? Absolutely not. Despite the fact that they have the exact same average historic revenue and income. So if you simply applied a multiple of earnings, you're going to undervalue, overvalue, and completely miss on some of these valuations. So I hope that hammers that point home. So what's the basics of income valuation? At the end of the day, it's kind of like losing weight. It's very simple. If you want to lose weight, you just burn off more than you take in, pretty simple. The valuation formula is very simple as well. It's just simply the expected cash flow divided by the expected rate of return that you would want in an investment for that risk, with a little bit factored in for growth. Be extremely careful with growth. A couple points on growth is that if you're the buyer of a company, if you're selling a company, at the time that company changes ownership, who should get credit for the growth? It should really be the person that's acquiring it. They're going to run it, they're going to manage it, they're going to take the risk. So sometimes we see small business owners want to factor in this growth rate. So, okay, well, if you're factoring the growth rate, then keep the company. But if someone takes it over, don't they deserve the growth? And technically, in theory, you can never grow a company faster than you can grow GDP, because eventually it would be larger than entire country. So we set a limitation of growth at about 3%. So that's the formula. And how do you get to those numbers? Well, businesses are based on their expected cash flow discounted for the risk. And typical small businesses should return about 20 to 40% for the risk that's taken. We will show how we get to that from a theoretical standpoint later. But in terms of a multiple, if you're familiar with multiple, it's just the inverse. So it's somewhere around 2 to 2.5 to about 5 times. Why is that? Anything below 20% is typically strategic, could be potentially high growth, or it's potentially overvalued. As you start getting up into 40, 50%, these are risky and might be considered turnaround situations. So certainly there's times, but if you start looking at the average small business that's just doing a decent job plugging away, they're typically going to be in that range. The average small business sells for about 3 to 4 times the cash flow. Again, depending on the size, it'll go up as we go up in size. So a business with $300,000 in cash flow will typically average about $900,000 to $1 million in sales. And as you go up size, stability, predictability of revenue, valuations will increase. So that's kind of the starting ballpark where we're going to look at small business valuation. This is what a valuation analyst does. This is the process that we go through as certified valuation analysts. We first of all take a look at the company. We understand the history and graph the last 3 years' revenue and income. If you've dealt with small businesses, Gary Cooper, one of our partners, deals with them all the time. Just getting those actual numbers from a small business can be extremely challenging. Typically, they're not going to be audited. They're not going to be reviewed. They can have a lot of personal expenses going in and out. But at the end of the day, you've got to get those numbers. If you're a small business owner out there, seriously consider reviewed financials. As you get up a little bit larger, consider audited financials. If you go to market, if you look at the valuation process, you've got to get this done, and it can be extremely costly and time-consuming to get this if you don't have it. The next step is to analyze all the external industry and company-specific qualitative risk. What does the company look like? The market. Certainly, we're in completely different times right now than we were in the fall of 2019. How's that going to impact the company? Local, geographic conditions. Are you in Detroit, Michigan? Are you in Austin, Texas? Are you in LA? Are you in Houston? Are you in an area where you've got union and higher taxes, or more business friendly? These are important factors that you have to look at and consider in the valuation. This is a little bit outside today's context, but you have to put the financial statements in common size and look at all the ratios. And you can compare them through RMA and different services to others in the industry. So you can compare the performance, just like a batting average, you can compare the performance of manufacturing companies to every manufacturing company throughout the US in that size, restaurants, dry cleaners, everything. This data is available. And you can just put your financial statements. So you say, okay, what's my operating income compared to other peers? What's my labor cost compared to other peers? What's my gross profit compared to other peers in my industry? So we take a look at that as valuation analysts, and then we kind of take a look and say, how much cash flow can we expect? And that's through a careful and thorough analysis of the current, historic, and upcoming future. We look at 3-year average, we look at year-over-year growth, we may look at the current period, and you can amortize, but you got to be careful with that. And once we start looking at the future, we start to get real careful with that. So say, how can you predict the future cash flows? Well, you can look backwards, but more importantly, you can say, what kind of revenue model does the company have? Do they have a recurring revenue model where they get paid every month for their service, month in, month out? Or are they going out and bidding every job? Casey and I did a valuation of a company one time. It had about $50 million in revenue, strong EBITDA, I think close to $5 million in EBITDA. They had one customer and they were doing a project for them. The customer accounted for about 80% of their sales and revenue. Our valuation was virtually nothing, and the company owner couldn't believe it. But you've got to look at the revenue stream. What's that made up of? How long has it been there? Do customers churn? Do they come in? Do they go out? So it's critical, but you've got to get comfortable with the cash flow that's coming in. And once you do that, you calculate your expected rate of return. Again, typically between about 20 and 33% on average, maybe a little higher for a riskier company. And there certainly can be extenuating reasons to be outside that range, but you better have a darn good reason for it. And then at the end of the day, you divide your expected cash flow by the expected rate of return, maybe a little bit for growth, and you come up with your valuation. But there's a lot that goes into it, a lot that goes into it. We'll start walking through that right now. So let's look at Linda's Flower Shop. So Linda's Flower Shop, she actually has one in Austin and one in Detroit. So we're going to graph her 3-year history. That's the one in Austin, 3 years of consistent growth, and that's the one in Detroit, 3 years of consistent decline. So $2 million in revenue, $400,000 in income. You think they're going to have the same valuation right now? You know, obviously not, but we see it all the time in the real world where someone just wants to apply an industry average to and come up with the valuation. So that's reason one why you can't do it, and that's step one in the valuation process. The next step would be a qualitative analysis. So Linda's Flower Shop in Austin. You take a look at the Austin market. It's a growing economy. It's strong. Linda's got a great internet presence. Her internet sales are growing. She's got the #1 SEO placement on Google up in Austin. She's got a really cool thing. She auto reorders for birthdays, anniversary, and other holidays. So, you know, all of us husbands out there, and we forget birthdays, anniversaries, and all those things all the time. We can set it up and Linda can take care of it, so it's done automatically. Really cool thing. She's got a good mix of walk-in, internet, and corporate customers. Her sales and profits are increasing. She's got meticulous financial records are updated. They're always accurate. She has reviewed financial statements. She has a CPA like Gary Cooper, make sure that they're all done right and done according to GAAP. She's got a state-of-the-art flower shop software management program that tells her all the products she's selling, the cost of each one. She's got written agreements with all of her vendors, and she's got all of her managers under a non-compete agreement, non-solicitation. So they can't just leave and start another flower shop. So that's Linda's Flower Shop in Austin. Let's compare it to her shop number two in Detroit. I'm from Detroit. I live in Houston, but I'm from Detroit, so I know what Detroit's like. It's been a declining economy. She's got one customer. It's Ford Motor. It's her largest customer. It accounts for 80% of her sales. Her longtime high school friend is the buyer and is going to be retiring soon. She has poor online reviews and virtually no internet presence. Here's a bonus tip for everybody, for all the business owners out there. Perhaps one of the biggest valuation keys in today's world are online reviews. If you've got poor online reviews, it's going to impact your valuation perhaps unlike anything else. It's just going to have a tremendously downward impact. On the other hand, if you've got 100 5-star reviews or 4.9s with maybe an occasional disgruntled customer out there, it's going to increase your marketability. So one of the really, really big things to focus on are your reviews. How do you look online? She handles every aspect of the buying and selling. She's got poorly kept records and financials, very outdated software program, no agreement with vendors, no managers that are under non-compete or non-solicitation. So any of her managers could walk out the door and take the customers to start a competing shop. So as you compare and contrast these two, still $2 million in revenue, $400,000 in cash flow. Obviously, they're going to have completely different valuations, right? So that's a job as you look to value a company, or if you're a business owner, you're looking, how do I compare? Is my company above average, below average? The next step is to calculate the free cash flow. Here's the general formula for calculating free cash flow. and it's free cash flow. It's what cash do I have at the end of the day that's unencumbered. I can do whatever I want with that cash flow. I can put it in my pocket. I can reinvest it in the company. I can go buy a sailboat with it. I can do whatever I want with that. So we take our net income after tax. We add back non-cash items, depreciation and amortization. We add back interest expense, but we have to make a deduction for any required capital expenditures. So again, if you're looking at a machine shop, a printing shop, anything in manufacturing, even a restaurant, what are you going to have to put back in the business from your free cash flow? You can't just stick that in your pocket and go do what you want with it. Okay, we add back all the seller's discretionary earnings, whatever they're taking out. If they're taking out trips, hunting trips, ski trips, cars, boats, whatever it is, we add it all back in, and then we make a reasonable deduction for manager salaries. Sometimes someone may take out $250,000, $300,000 a year, and it really might only cost $125,000 as a reasonable salary to run that company. So we may add back $200,000. Sometimes they may be taking out $70,000, but a reasonable salary might be $125,000. So you have to take out an additional $50,000 or more. So you have to take a look at that. In the case of Linda's Flower Shop, it's given that the free cash flow is $400,000. Work with professionals who have expertise in calculating cash flow. Again, it's not based on net income. It's not based on an accounting number. It's not even based on a tax return. Warren Buffett used to say that cash is king and all of accounting is up for interpretation. So you've got to get down to what is the cash flow that business is throwing off. So again, work with experts in doing that and get to that number. Once you've got that number, here's a little bit more on discretionary earnings. So seller's discretionary earnings are all the economic benefits available to the seller. It can be salaries, insurance, entertainment, everything, all added back in, and then a reasonable deduction is made for what a reasonable salary would be. So just make sure you take that in consideration. Again, sometimes a very small business may be valued on SDE, but it's going to be a lower value. So we saw up there earlier in the Pepperdine study that SDE is sometimes 2 to 2.2. Well, if you take out a salary for that, the valuation might jump up into the more normal range, 3 to 3.5. But just take that into consideration. Big trap when you start to look at small business valuation. Let's talk real quickly about how do you calculate the risk, and theoretically, how do we get up to this 20 to 40% or this range of these small businesses come in? Well, it's all based on the theory of building up to something that's comparable risk. So why would an investor ever take more risk for something that's going to pay a lower return? You would never do that, right? Investors seek the highest return for the least amount of risk. So I could take my money and I could put it in treasury bills, risk-free. Typically, I'm going to earn 2 to 3%. In today's world, it's only about 1%. I could go put my money in corporate bonds. Now, these are diversified corporate bonds. So if 1 or 2 of them go out, I'm not going to lose my money. I'm going to get an additional 2 to 3% risk. I could go put my money into a basket of large company stocks, Microsoft, Apple, Tesla, everything. Historically, I'm going to get about 7% risk premium for that. So now all of a sudden I'm at 7, 8%. If I want to take more risk, I can put them into smaller stocks. I could take a whole basket of smaller stocks and put my money in that. Some are going to go out of business, certainly, but on average, some are going to really grow. So you add all that up, and my minimum expected rate of return to invest in a small business, and I'm not only invest in one, it's hard to diversify. Maybe as a private equity group, you can diversify, but as an individual, you can't. Or if looking at an individual company, I'm going to expect a minimum return, certainly somewhere in the 18 to 20% range. Okay. Again, as a multiple of earnings, that's 5 times. So unless I'm really see something I like, or I can grow this or something, that's going to be the range. All right. Maybe I come down to 6 times or 17, 18% return, if I really see that it's completely, maybe software as a service, recurring revenue, very little risk, some growth opportunities, certainly I can come out of that range. But, we're kind of talking about the normal range. So that's the normal range as you look at it. So we build up to that. So we've built up to this about 20%. Now here's where it gets real interesting as we start to look at individual companies. Individual companies are going to have their own specific risks. They're called company-specific risks, right? So as we looked at Linda's Flower Shop, Austin, Linda Flower Shop, Detroit, they're different risk profiles. This is really the key that as a valuation analyst or looking to do a valuation of a company, you've got to dig into, okay? You start and say, okay, how is the business dependent upon the owner? Are there clean and audited financials? Is there recurring revenue? Is there no customer concentration? Do they have a good reputation, strong online presence, good growth opportunities, and other factors that are going to reduce risk and warrant a higher valuation? And companies that are more risky just warrant an additional premium, right? People always ask, how does that range? Well, people that are, if you're on the sell side and you're a seller of a business or you want to increase your company's value, you have to understand that investor, that buyer on the other side is going to look at that risk. It's like looking at a used car with 50,000 miles on it. You're going to fear the worst. You're going to fear it's going to break down, or there's problems or there's issues. So every risk that you have in your company is going to be discounted for by a potential buyer if they can't get comfortable with it or mitigate that risk. So I'm going to teach another section in August on the keys to increasing value. But here's a preview to that. As a business owner, you have to do everything you possibly can to take that risk away. There's a Nobel Peace Prize that was won called the prospect theory by Tanneman and Tversky, and they concluded that risk is asymmetrical. People look at losing a lot more than they look at winning. So when the optimistic entrepreneur meets the pessimistic buyer and investor, it's not symmetrical. That risk that's in the business is going to get discounted further by the investor maybe than the reality. So the seller of the business is, oh, it's no big deal. We've got great relationships and no one's going to leave here. We don't have to have a contract. Well, that risk is going to get magnified by the potential investor, and they're going to decrease the value of that company, right, by increasing that risk. So this is the job of a valuation expert like us, independent, or somebody looking to acquire a company or come up with value, is to look at the specific risks in that company, right? And what are they? What are they? These are common specific risks of a small business. You've got dependency on the owner. If that owner is in there and that business is completely dependent on, he's got the relationship, he knows his people, he's handling sales, he's handling everything. He's the engine, he or she is the engine of that business. And when you remove that engine, you've got a car, right, without an engine. You've got a business that really has very little value. That's one of the biggest impacts to value of a small business, is what's going to happen to that owner, what's going to happen to the company when the owner leaves. So dependency on the owner, consistency and inconsistency of the revenue stream. These are the two keys which just can significantly increase business value. The conditions of the financial statements. Are there barriers to enter? Can anyone come into the market? Are there any moats like patents, trade secrets, ease of switching? What's the brand awareness look like out there? Online, is it a good brand? Is it strong? Good reputation, good PR? Are there irregular capital expenditures? Is stuff consistently breaking down? Right? Are you buying an old factory and you're going to have to consistently come in there and replace stuff? Are there employment contracts? Can your key managers leave? Can your salespeople leave? In Texas, people say, well, you can't enforce employment contracts. Well, no, but I can enforce a non-solicitation clause where you can't go out and solicit any customer that we have. I can't stop you from going to work for a competitor all the time, but I can't stop you from calling or revealing anything that you've learned internally. So good, solid, well-written agreements. And this goes for leases and contracts and everything else, right? And how long is that customer loyalty? How long is that longevity? Are leases assignable? We had a client that we worked with several years ago and had contracts with major companies. They weren't assignable. So we weren't able to get through due diligence because he didn't want to tell his customers that he was selling the business, and the buyer wouldn't move forward until the customer signed off. So we got in this catch-22. You know, current lawsuits, any pending lawsuits, any legal action will increase risk. Outdated inventory, equipment, you know, all these things. There's just so many risks, potential risk in a small business, and that's what a valuation person does. They look at these risks and they evaluate them, and they kind of just put them up on a scale. So if we look at how do we calculate, how do we incorporate all this? If we start at a basis of somewhere around 18 to 20% return, right, for just investing in a small company, now we need to add the company-specific risk. And typically we're going to come up, again, I'm talking about normal ranges in companies, is somewhere around, you know, maybe very little. You might say, you know what, as you go through your checklist, and we literally go through a checklist when we're doing evaluation, and we say, you know, we check off these risks. And as we see more and more risk, we just simply move up, you know, our expected rate of return because we're taking more risks. And we'll move them up till we get kind of about average, and then we'll either move them up or down. So the same size companies in the same industry can have completely different values. So let's revisit Linda's Flower Shop. All right, so if we go back, we've got the cash flow stream, which we've just done an assumption of $400,000. That's what it is. The required rate of return minus some growth, right? Just think in terms of Detroit, trending down, lots of add backs, poor qualitative risk analysis. Just intuitively, are you going to put that in 0? You're going to put that maybe a 10% increase in risk, or you put it towards the far end, somewhere 20% or more. Well, certainly that's going to be somewhere at the far end, maybe 20% or more, right? You see that. Austin, on the other hand, cash flows are trending up, clean financials, no add backs, great qualitative risk analysis. You're not going to have a whole lot of additional risk that you're going to put on there. Recurring revenue, maybe you even come off that a little bit. So you're going to pay a lot higher valuation for that. So, you know, let's move forward. And this is literally what we do at the end of a valuation. We look at the valuation curve, as we call it. We say, okay, we're going to start in the middle. Again, you know, maybe 3 to 4 times in the middle. So where would we put Detroit? Detroit's going to be extremely low, very, very risky. So value is going to certainly be on the lower end. With $400,000 in cash flow, there's a lot of risk to those cash flow. They lose Ford Motor Company, sales rep leaves, Linda's friend retires as the buyer, all those things. So you've got to compensate for that risk. It's $800,000, maybe lower, right? Our value of Austin's going to be extremely high value. Lower risk, recurring revenue, great reviews. The value is going to be on the high side. Probably willing to pay somewhere, you know, $1.6 million and more, you know, $2 million on that. So this is what we do to really start to determine value. Certainly, we go into financial calculations, financial models, and everything, but we get close first. So what's the answer? What's the answer? The average value of a small business is actually 3.67 times the free cash flow for a small business from the Pepperdine study, or about a 0.275% expected rate of return. So the average value, the average expected value going into this for Linda's Flower Shop would be $1.468 million. Just to note that valuation is expressed in terms of multiple of earnings as well. So a multiple of earnings is just the expected rate of return, the inverse of it. So if you expect to get a 25% return, that's a four times your earnings. So I hope you understand that. So the answer is 1.468. I'll check in with Casey, see who was closest to that. Here's my concluding thoughts. Companies must be valued on their own merit, both for opportunity and risk. Be extremely wary of any type of averages or comparisons. Be extremely careful of add backs. All cash flow is not equal. The fear of losing money has more influence on investment decisions. So the best thing a business owner can do is just simply start to remove the risk. Steady recurring revenue will ultimately bring the highest value. A strategic buyer can bring synergy, cost savings, additional cash flow will pay more than fair market value often. The COVID disruption will significantly impact some, and it will help others. We'll talk about that a little bit. And independent valuation can be beneficial for many reasons. So that was kind of an overview of how valuation is calculated. And on August 12th, I'll be continuing a series in how to increase value. So Andrew, I'll turn it back over to you.
Awesome. Thanks, Al. Yeah, we're going to kick off some Q&A, but what we'll do real quick, I'm going to announce kind of the next town halls so that we can save time for Q&A if people need to leave, and then we'll just stay online a little bit longer because we have a lot of questions. So as you can see here, Gary Cooper is going to be continuing his three-part series of how to build a service-based business. And the part 2 is going to focus on human capital, accountability, and internal reporting. So that's a really good series. If you missed the first one, you can go and download it on our website to get caught up, but don't miss that one next week. And then as Al just said, we'll be continuing his, and then Jason Knight's going to also be presenting in 2 weeks about entrepreneur operating systems. So a lot of good stuff coming up, and it will continue to. So we'll go over to the questions now. Real quick, we've had a lot come through regarding what are the best guides for valuation, what are really good resources, where do we get our industry research. Rather than going through all of those, I actually found Rice and Vanderbilt does the same thing. Rice has a public page, and I shared it in the chat, and it kind of goes through and it ranks what each research platform does and what it's good at and what it's not good at. So just take a look at those. They're in the chat. I put one in there for company and industry information and one for, best place to find financial information. And then there is another one that comes from Vanderbilt, and it kind of ranks and tells you where to find this stuff. Some of it's going to be expensive, some of it's free. So you just have to kind of figure out bang for buck what you're looking for.
One other thing that I might add, I might make a plug for NACFA and the CVA. CVA is a Certified Valuation Analyst. So if you have a master's degree or you have a degree in finance accounting, that meets the educational requirement. And through NACFA, you can take online classes now and then sit and take the class for the certification. And then you have to have practical experience, work on 10 business valuations. A lot of business valuation firms, accounting firms will let you kind of come in and intern to get that experience, and then you have to take a pretty comprehensive test. But it's a good designation, and valuation is a really increasing field. It's required in so many for so many tax reasons now. It's required every time there's given equity comp. So if you have a degree in finance accounting or an MBA, it's a pretty painless designation to get moving forward. And there's a lot of good books out there on the topic too. I'll actually send you, I wrote an ebook on the valuation process. We can send that out.
Yeah, we'll give everyone the link to download that when we send out the follow-up email. Al, so when we were talking about change of multiple, I started to answer this, but someone asked if the multiple, if real estate's included, does that change the multiple? I kind of specified that usually in those cases, they're two separate transactions. There's a different APA purchase agreement for the business and one for the land, but maybe you can elaborate.
Yeah, very, very, very important. So businesses are valued on their income, on their cash flow. Real estate is separate. So my advice to any business owner out there, any advisor, is to always have your real estate in a separate company and then have a fair market lease that goes back to that real estate company. Some buyers of businesses like to have real estate and others don't. So, and sometimes what we see a lot, especially in an area where business may appreciate, or real estate may appreciate a lot. Casey and I did a valuation in Bel Air, and somewhere out on the west side of town, and the real estate actually appreciated to where you would never put a business on that real estate. The fair market lease, the business was worth more by just selling the real estate than it was by having that. It was a nursery. And the cash flows from the nursery could not cover the fair market lease. So keep them separate, and they are two separate valuations.
Awesome, thanks.
But if the business is on the real estate, the cost is deducted. So I want to be clear that you do not take the valuation of the real estate plus the valuation of the business, right? Without deducting the cost of that business being on that real estate.
Al, can you talk about personal risk and how that's kept separate from company risk if you're going to buy a distressed company?
Well, it all depends on that. That's a question of financing. So your personal risk, if certainly if you put all your money up and you take that risk, you're going to lose all your time and opportunity. You could potentially lose all your money. If you sign on a line of credit, if you sign on a loan, potentially, you're liable for that. If you want to share in that risk and go out and get a group of investors, and let's say you owe them, let's say you're going to buy something for $1 million, you could put $1 million of your own money into it. You can go borrow $1 million on your own. You could have 4 investors, each put up $250,000, and you run the business, and then you negotiate, equity terms with them, right? You could do a combination of that. You could do part equity, part debt. One important factor to understand, sometimes when we talk about WACC and other things, when you look at the enterprise of a small business, if you have a business that's worth $500,000 and it's financed with 0 debt, it's still worth $500,000. If you have business worth $500,000 and you finance it with $400,000 in debt and $100,000 in equity, it's still worth $500,000. Sometimes MBA students actually have more of a challenge with that than maybe a non-technical person who hasn't seen valuation before. When you talk about enterprise value, equity value changes, but not enterprise value.
Perfect. Let's see. What are some of the best rules of thumb to get a quick idea if a deal is worth pursuing? I'm guessing that's related to buy side. It could actually apply to sell side too. So really, how do you vet a target?
Yeah, I mean, you can certainly, look at something like the Pepperdine study and see what the average is. And look, if somebody is, we had a person, we see it a lot in our world. We had a person that came to us and did about $200,000 in earnings and said they had to sell their business for $2 million. That's a 10% return. It's 10 times earnings. It's just, well, that's what I need to retire. And it was like, what you need to retire does not impact the value of your business. And so they had to readjust, and they had to work a few more years to get it up to that point. So, you can look at a general rule of thumb, but if you really can look at the cash flows of it and apply some of those ranges that we talked about, you can get a good feel for it, right? So that Pepperdine study is a pretty good one, depending on what you're looking at. But again, the average business in the U.S. sells for about 3.5 times cash flow. Up to maybe a couple $1 million, $1 million, $1.5 million. And it goes up from there. Right?
I'm just going through, we've got a lot of submitted questions and a lot in the chat, so I'm just kind of tackling them as they seem relevant. How do taxes factor in to valuation, Al?
Taxes are an expense, like anything else. So that's another thing. Sometimes you say, well, what? It's a multiple EBITDA. It's a multiple of the cash flow. So when we look at valuing the business, you have to put some type of consideration in there for taxes. Ironically, when the corporate tax rates went from 35 to 21%, we were in the middle of some valuations, and we literally added 14% back in. You have to look taxes and expense like anything else. So at the end of the day, what's the free cash flow that's going to go in your pocket, right? So you have to take that in consideration.
For professional service firms, what type of multiples have you seen, and how do you limit that key person risk?
Yeah, that's a great question. So typically, there's just kind of an unwritten rule with a decent professional, but we just talked about it, right? So again, is there a professional services firm that has to go out there and hunt the new business every year in and year out? Or is there a professional services firm that like Cooper CPA that has recurring revenue every single year? Probably 90% plus businesses go back to the same CPA year in and year out. If you have a consulting project, that's a one-off deal, it's going to be completely different, right? So you have to look at that. So professional service firms with recurring revenue, I think they're typically and again, I just hate to say, but I'm going to say average, might be about 1 times revenue, but again, that's average, and we just had an hour-long conversation on averages. So
here's a good one.
How do you mitigate the key risk? Some type of shared a seller note, shared equity going forward, non-compete agreement, some type of participation or role in the new company, right? To do that. But that's the very first risk that has to be assessed for the small business is the owner's risk. What's going to happen if they leave, and typically you want to have them, as a part of the company.
You touched on this earlier, and this was another question, so I'm just going to throw it in real quick. Do you adjust the valuation based on the personal risk or carrying of seller financing? I guess focus more on the seller financing. How would you weigh into the valuation with that? Or does it?
So there's valuation, right? And then there's term. So if I said the value of that business is $1 million, that's I was going to pay you $50,000 for the next 20 years. That's a heck of a lot different than saying I'm going to pay you $1 million today, right? So these are all tools that a buyer can use to mitigate the risk. Seller financing is one of them. If you're not as comfortable with that risk, especially with the owner leaving, then you may have more seller financing. If it's all contracted revenue and recurring, and the owner of the company has been traveling the world for the last couple of years, then you're not going to be as concerned with it. You may pay more up front. Again, just to reemphasize my point, each individual business and valuation and acquisition terms warrant its own investigation. Again, that's the takeaway that I want everyone to take out of this. And depending on your assessment, then you come back with different tools. A seller note is a tool, right? Paying more cash up front can be a tool to get lower price too, right? If you're comfortable with the risk or you can mitigate it.
Al, here's a good one. So we were focusing on EBITDA valuation, but does that not take into account any fixed assets like inventory, excess working capital? So the idea is, do you ever merge a DCF valuation with an asset-based approach, or do you have to choose one or the other?
Okay, here's a general, in the valuation is the operating assets. How much is the historic working capital, right? How much cash, inventory, receivables do I typically have in that? So in acquiring a business, you want to make sure that the seller is not going to drain all the working capital right out of the business. So there's a minimum that's going to be required. Anything above that, right, can get added to the value of the business. You can add that to the value of business, but anything that's required to operate that business goes in the valuation typically, and goes in the, will go in the purchase price. Those are operating assets. Assets that are outside of that again, land and building can be one, but you have to have land and building to operate a business. So that has to be a part of that has to be an operating expense that's taking out, right?
Gotcha. All right, let's see. We got one more, unless there are any others that come through. With the likelihood of tougher debt markets, what tools can searchers use to fill them in on valuation gaps with sellers?
So Andrew and I are writing a white paper on that, and kind of like getting a deal done in today's world, COVID, post-COVID and everything. So very familiar with the search fund and searchers that are out there. So certainly a seller note, shared equity, some type of incentive comp going forward. We had an alum of the Jones School several years ago. We call it a rent-to-own model, where you might take it, and this is a really good time for that, where you have a retiring person that says, you know what, dang, I missed the window, valuations are down, the market's soft, I'd really like to move on to retirement, take money off the table, but I don't want to give up, maybe that valuation. So here's a really good tool that can be used, where the younger, more energetic person comes in and takes over a part of the business, and the older owner stays in there for wisdom, guidance, phone calls, transition, and everything. And it's a partial buyout, with a partial buyout that's done later. So we've had a couple of our alums that have done that. They've gotten out of the Jones School, and they've come on and they've taken over. They're kind of like an operating officer, and they slowly take the company over. Hey, Andy, before we get to Casey, who won the gift certificate?
It looks like there was two people that were very close. Runner-up was Khan Goons, and the winner was Saud Khan. He was closest with a guess of 1.5 million.
What was the lowest?
The lowest was, I think there was an $800,000 guess, which would have been spot on for the Detroit location. Yeah. And there was some as high as 12 million. So we had quite the range.
Might have been a typo. Maybe they meant 1.2.
Maybe.
So I'm sure the 12, they got their money's worth then. They learned the most about the process.
Mm-hmm.
Yeah, well, that's all we've got now. I would kind of leave it with this closing question, Al, which you can snowball into your next series. But what are the best ways to increase the value of your business?
All right. Well, look, if you're a business owner out there, number one is get the heck out of the business. Maybe Jason Knight on August 5th can tell you to get an operating system in there so you can remove yourself from the business. I mean, it's eliminating risk. It's going through everything that we talked about today. Clean financial records and transparency. The more transparent that you can become, the better, all the way around. And again, on August 12th, we'll talk about all that. How you take this and these lessons, and you turn around in ways to increase the business value. There's a lot of it. Gary, any thoughts?
Well, I think, obviously the company specific risk is removing yourself as much as possible from the business, having repeatable income, and proving up sustainability. I mean, over a period of time, if you show you have sustainable income, especially with COVID-19, I think some of these companies that have proven that is actually going to probably have a higher multiple if they've been able to weather this and stay even. So, yeah, I think you did a great job, man. That was even for somebody who understands valuation, that was really fun to listen to, and you did wonderful.
There was a lot to put into an hour-long presentation. There's lots to the evaluation process, a lot more than meets the eye.
Yep.
Great. Well, thank everybody. Thank you for your time, patience, and hey, and reach out with any questions at any time. I'd love to talk about the process, and we love to educate and train as well.
Yeah, we had a lot of questions about will we dive deeper into the valuation process, into the due diligence process, and we're just scraping the surface here. So we're gonna be going a lot deeper every week.
Yep.
All right. Well, thanks everyone.
Thank you, Andrew.
Thanks, guys.